I'm joined today by Paul Jordan, who runs the Amati UK Smaller Companies Fund. Hello, Paul.
Hello.
So lots to talk about, but I guess first if we could talk about performance. I mean, the Amati UK Smaller Companies Fund has been a strong performer for a number of years. I mean, what have you done that sets you apart from the rest?
Well, in Amati, we bring together a team of very experienced fund managers who've been doing the job a long time, and we have a team-based approach to constructing a portfolio. So if you like, we divide up the universe of stocks that we look at by sector, and each of us develops certain sector expertise. So the key idea that we bring, if you like, is that we think that running the fund as a team allows us to build a portfolio that's better than any one of us could have built. And we sometimes make the analogy of harking back to the name of our company, which is named after a violin maker, or we think of the workshop of a great violin maker, and if you like, we're bringing quite traditional skills of fund management, the craft of fund management to bear, if you like, on what we're doing.
Okay, so what sort of do you look for in a company? AIM, the small cap arena, full of great companies. It's also full of some companies that you might not want to invest in at the moment. But what do you look for in a business before you invest your money?
We look for a very large number of different things, but I mean, the easiest ones to articulate would be a business. We look for a business that's needed, for one thing. There's one question we sometimes ask ourselves about a company is, if this company didn't exist, would anybody miss it? So we look for businesses that are playing a role that serves its customers well, and that they are going to want to have for a long time. And then we look at lots of different sort of quality measures, whether that's cash flow conversion, or whether it's visibility of revenue. We're looking at the strength and experience of the management team, the culture of a business, how it's run. If you like, trying to weed out signs of risks that we don't want to take, and clearly when you invest in a company, you're taking on some risks. So we try to understand exactly what those risks are, and then when you construct a portfolio, one thing you're thinking about is having a set of risks that don't overlap too much. So you choose to take certain kinds of risks, and you want them to be very well balanced, and you want them to be minimised and well managed.
Okay, so when you talk about risk, so I mean, given the current domestic and international political and economic events and headwinds, performance has been fantastic. I mean, do you envisage it being more difficult to maintain that level of performance given these headwinds?
Yeah, it's one interesting thing that a lot gets talked about markets, about short-term movements and what happens in the space of a year. I mean, the kinds of things you're talking about there are concerns if you're thinking long-term. So what's going to happen over the next 10 years? Then policy mistakes, policy decisions taken now will have a big impact. But it's easy to then overestimate what happens in the short run. And then, conversely, when we're in a situation of a day-to-day sort of crises in Parliament, they can swing the market around a lot, but sometimes for not very good reasons, and then the market swings one way wildly and then swings back. And that's a sign that, if you like, what's going on politically is causing a lot of confusion. People are trying to sift what are the longer term implications going to be, and clearly we're part of that.
Okay. Well, I mean, you mentioned sort of Brexit and its short-term impact on market movement. So I guess it's you try and cut through the noise there. But I guess in terms of the economic cycle, I mean, do you accept that we're late cycle currently, and if so, does that affect your investment behaviour in any way?
It does, and working out where you are in a business cycle is notoriously difficult. The job would be very easy if we knew. But I think, having said that, it's sensible to assume and to behave as if we're in a relatively late cycle point, partly because the bull market, if you like, that we're in has been going on since 2009, and that's quite a long time. These things don't go on forever. So what does that mean for us? It means carrying relatively high levels of liquidity, being a bit more reluctant to take liquidity risk where we don't need to. It means buying businesses that are not over-leveraged, being very careful about leverage. It means buying businesses that are robust and can withstand a certain degree of shock to the system. And those things all make a lot of sense to us for the current environment, not least because of the hypothesis it might be late cycle, but also because when you have major uncertainties, as we have at the moment with very specific uncertainties like Brexit, it makes sense to have a degree of caution.
You also run the Amity AIM Venture Capital Trust. It'd be interesting to know how how do you leverage that to the benefit of the small cap fund?
So I've been managing UK small cap funds for a long time, since the year 2000, and I've been managing VCTs always in teams since 2005. And one of the reasons for starting a VCT was, I suppose, recognising that there's a lot of synergy in the research you do to run an AIM-based VCT, which is what we do. So the Amarty's Venture Capital Trust only invests in companies that are on AIM. And the research that we do for that really feeds very well into the Small Companies Fund. It builds our intelligence, if you like, about the things that are coming around the corner, whether those are technologies or market trends, or something that the new retailers are doing, or whether it's some devices in healthcare. And it gives us a position where we get to know these companies very early on very well. And when they reach a certain point of having de-risked, then we can buy them in the Small Companies Fund, probably before that many people really know about them.
One of the big topics at the moment, for very good reasons, is liquidity. So is liquidity in the small cap space something that you're concerned about? And equally, is it something that the industry regulator could or should intervene into?
Okay, well, those are two quite different questions. I think on the first question, I think every small companies fund manager in the sector will always be very keen to manage liquidity well. It's one of the core skills, if you like, of running a small companies fund. And I suppose our approach to that has been, there are times in the cycle when you want to be cautious about liquidity, and there are times in the cycle when you want to be brave about it. And actually one of the best strategies, most profitable strategies for the small companies fund over the last couple of cycles, thinking about the downturns in 2003 and 2008, was to be willing to take liquidity risk when the market's very beaten up and when nobody really wants to take it. And conversely, when there's a lot of optimism and buoyancy in the market, it's better to be a bit more frightened of taking liquidity risk. And so being contrarian with liquidity risk, I think, is one of our core strategies. And that's certainly something that we aim to manage in the future. I think on the second question, should the regulator intervene over liquidity? And the regulator has made some comments, for example, on the BBC Panorama programme the other night, saying that they want to look at the area. I think it's very specific what should be looked at, and it's very important to be clear about it. And unfortunately, the Panorama programme, if you like, missed some key points, I think. The key point for open-ended funds is that open-ended funds should basically not invest in unquoted companies. Unquoted companies are they're a great area to invest in if that's your specialty. It's not our specialty, but there are many private equity managers and venture capital managers who really know how to operate in that area. But the structure that's suitable for that is not open-ended funds. They're simply not designed for it. And that's a very different thing from sort of saying, well, we're going to come up with all kinds of liquidity measures and impose those on open-ended funds per se. I think that would be a mistake. But that should really be left to managers to manage the liquidity risk in their fund sensibly. But with any quoted stock, there are always possibilities of trading, and it's simply a matter of what the price is. So the market is a price-finding mechanism. The difference with an unquoted stock is there are very rarely opportunities to trade, and they come along occasionally, and particularly if you're dealing with early-stage companies, loss-making companies, then by the very nature of things, you're in competition with the company itself to find buyers for those shares. And that means if you want to realise the value of your holding before the company is turned into a profitable business, that's going to be incredibly hard to do. So I think the fact that the rules make it possible for open-ended funds to invest in unquoted equities, that could be looked at and that could be changed, but I don't think it should go any further than that.
Cool. Thank you very much.